Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, May 20th. Rate cuts in China and Australia, a strong IPO from CATL in Hong Kong, and the European Union and UK deal somehow counter the darkening trade headlines. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own, and this is not financial advice. So the People's Bank of China and the Reserve Bank of Australia lowered their interest rates at their meetings today in hope to tame and eventually counter the negative impact of the global trade war on their economies and on their jobs. So the moves were expected, they were wildly expected, and had a mixed echo across the global markets. The CSI 300 index is up by 0.62%. For example, at the time I'm talking here this morning, Hang Seng index has jumped around 1.30% as the CATL IPO also went according to the plan and was quite strong and led to a 14% jump in its debut in Hong Kong, while the Australian ASX index is giving back earlier gains as trade headlines are turning sour. Now remember, the US, which is not happy with the pace of negotiations with trade partners, announced last week, by the end of last week, that it will announce its unilateral tariffs on its trade partners before the end of the 90-day tariff pause period. Trump insists, on the other hand, that Apple, for example, which produces iPhones in China and moving production toward India, produces them in the US instead. And it now wants the company to abandon its AI partnership with Alibaba for phones that it sells in China. And the latter is another blow, obviously, for Apple's Chinese business plans, as AI-powered systems in China and Chinese phones could reverse Apple's falling market share in the EM giant, and partnering up with a local player was an excellent, a very smart idea given the severe restrictions to access information in China. Alas, it may not be possible under Trump administration. As such, Apple that pledged to invest up to $500 billion in the United States, yes, $500 billion could be brought to spend that money for building iPhones instead of spending it for innovation and technology. So I don't see a better way to lend leadership to China. Because meanwhile, in China, obviously the demographic and home crisis continues, even though we don't talk about it every day, they continue. But on the other hand, the technology advances continue as well to challenge the Western peers. In this context, companies like Alibaba and Baidu, for example, were on AI models. Others, including Huawei and SMIC, are producing chips, while companies like BYD, Xpeng, and Xiaomi challenge, for example, Tesla globally by building powerful but cheaper electric vehicles. Xiaomi, for example, announced that its new model that competes with Tesla's Model Y will be launched in China this Thursday. So Xiaomi's price is up by 4% today, and it's approaching its all-time high levels. In summary, all in all, sentiment for Chinese technology is somehow improving, not as fast as the US big tech of the past 2 years, but it's improving, and lower rates in China and ample fiscal support should also help. Across the Pacific Ocean, appetite for the US big technology is there as well, but the valuations could be just too high if Donald Trump's trade war backfires on these big technology companies, forcing them to waste money for reorganizing their supply chains and producing in the US, for example, and or go into a regulatory battle with the European Union, for example, a battle that could have been avoided, that could still be avoided, by the way. So speaking of Europeans, good news came from the European Union and the United Kingdom yesterday. They sealed the most comprehensive deal yet since Brexit and pledged to discuss British access to Europe's $150 billion worth of a defense fund. So the Stoxx Europe Aerospace and Defense ETF soared 2% yesterday to a fresh high level, as the Stoxx 600 eked out a small gain despite the looming tariff hit. The index has now recovered around 80% of its March to April decline and approaches the all-time high levels yet again, but also the overbought market conditions. On the data front, yesterday's economic data, the CPI data actually released in the Eurozone, confirmed an advance in April of core inflation to 2.7%, but the undesired turn of the CPI data was somehow countered by the latest inflation forecast from the European Union's Commission that sees the Eurozone inflation slow toward the 2% target by the middle of this year and average around 1.7% in 2026. So the latter should give the European Central Bank enough space, enough room to keep the interest rates at a sweetish spot and support growth prospects for the European economies, along with easing energy prices and potential end of the Ukrainian war. So the euro dollar rallied to 112.88 level at yesterday's trading session and remains bid against a broadly softer US dollar, while the German sovereign papers attract global buyers looking for alternative solutions, alternative low-risk bonds to the US debt that just lost the last AAA rating from Moody's, remember. Now, interestingly, investors were too rapid to shrug off the negative feelings of the US rating cut of last week, as the US 10-year yield fell below the 4.5% level to close the session, while the 30-year yield in the US returned below that 5% psychological and scary mark. But the narrative of the falling international confidence in the US treasuries and also the US dollar remains intact, opening windows of opportunity elsewhere than the United States and its sovereign bond markets, and that's obviously exciting for investors who are willing to eventually find the next big destination. On the Federal Reserve front, still in the US, New York Fed's Williams said that it is not going to be that in June or in July that they're going to understand what's happening, but that it will be a process of collecting data, getting a better picture and watching things develop. Speaking of the trade war, while Atlanta Fed's Mr. Bostic said that he sees no more than one rate cut delivered from the Federal Reserve this year due to uncertainty. So in the equity space, the S&P 500 reversed early session losses to finish the session slightly higher, but the trade tensions, the trade uncertainties, the Fed's reluctance to show its support in the face of the rising inflation expectations and the rising inflation risk, and the political and geopolitical unpredictability obviously loom. In the individual space, though, Nvidia announced that it will let the third-party chips use its NVLink Fusion program and be able to connect their own third-party CPUs with Nvidia's GPUs in AI data centers, said Mr. Jensen Huang, in an effort to turn a competitive risk of more players building their own chips into an opportunity to be the high-performance bridge everyone uses. So Nvidia shares recovered early losses on Monday and closed above the $135 level. Is still a good place to be. Elsewhere, Home Depot and Lowe's earnings will be in focus this week in the US to complete the US consumer mosaic in the midst of the trade turmoil. So these companies remain very much exposed to the trade war and will be forced to raise the prices of their products despite declining sales to protect their margins. Because a company like Home Depot, for example, has a net profit margin of around 10%, and a company like Walmart operates within a profit margin of around 3% and even less than that. So with the tariffs ranging between 10 to 30%, it will be quite hard for these companies not to raise prices. In the sense, higher prices mean higher inflation and higher inflation expectations. Higher inflation means limited Federal Reserve support to the economy. Limited Fed support could mean slower economic growth for the US economy. Slower economic growth combined with rising inflation means stagflation. a potentially further debt spiral and further financial pain, unless a miracle happens. So fingers crossed, maybe we will have some good news, who knows. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.